Hello and welcome. I'm Lisa Mahoney, an accredited financial counselor, and today we're talking about confident investing. This is not about chasing returns or predicting the market. It's about understanding how to start investing and, just as importantly, how to stay invested for the long term. If investing has ever felt intimidating, confusing, or risky, you are absolutely not alone. This video is designed to help you understand why investing matters and how to approach it with confidence instead of fear. This presentation, live streamed, or on demand, is for educational purposes only and does not constitute financial, legal, or tax advice. The concepts and strategies shared are intended to inform and empower, but may not be suitable for your specific circumstances. Consult with a team of qualified financial professionals, including but not limited to registered investment advisors, accredited financial counselors, tax professionals, and attorneys for personalized advice tailored to your unique needs. Any references to specific companies, products, or services are for illustrative purposes only and do not constitute endorsements. Investment involves risk, and examples presented are not a warranty of results. By participating in or viewing this content, you agree to assume full responsibility for your financial decisions and outcomes based on the information provided. Before we talk about accounts or strategies, let's start with something more important. What's important to you? Not just money, but what money supports. Security, flexibility, independence, peace of mind. Investing only makes sense when it's connected to something meaningful. Without that connection, it's very hard to stay committed when markets get uncomfortable. Let's slow down and walk through this example carefully because this is often where people think, that can't be real. This illustration assumes a starting balance of zero, an average salary of $66,622 with no pay increases, consistently investing 10% of that salary over 36 years, and with a long-term average return of about 10.2%, which is similar to the S&P 500. What makes this number look so large isn't luck, perfect timing, or stock picking. It's time and consistency. In the early years, growth looks slow, sometimes even disappointing. Most of the growth happens later when your money has had time to compound. Earnings begin earning earnings. That's why starting earlier matters far more than investing perfectly. And if you're thinking, I don't earn this salary, I can't invest 10%, or I don't have 36 years, that's okay. This example shows a concept, not a requirement. It is never too late to start. We don't invest to beat the market, we invest to support the life we want. That mindset removes pressure, and pressure is what leads to poor investing decisions. When we think about why investing is important, there are individual reasons to invest, and this visual reframes how we think about money. Money is a tool, not the goal. Money creates choices. Choices support security. Security creates freedom. Investing is simply how we help money maintain and grow its ability to support us over time. Let's talk about why investing matters. Investing matters because inflation quietly erodes purchasing power over time. It matters because large expenses are unavoidable: homes, vehicles, education, and life milestones. And most importantly, investing gives you options later in life. Retirement isn't an age, it's a level of financial readiness. Saving and investing are teammates, not competitors. Saving protects today, investing protects tomorrow. Confident investors understand when to use each. We're going to talk about how to make investing safer. You don't need brilliance to be a successful investor. You need consistency, patience, and a plan that accounts for human behavior, especially emotions. If market uncertainty or fear has ever caused you to pause or panic, you might also find it helpful to watch my video called Preparing for Financial Uncertainty, where we focus on building resilience before emotions take over. Let's talk about how to align your money with your goals. And different goals need different tools. Emergency funds belong in cash, and they should go into an online high yield savings account. This ensures that you are maximizing interest and not risking any loss. Midterm goals can use taxable investing. Retirement goals belong in tax favored accounts. This alignment alone reduces stress because your money has a clear job. Building taxable funds before retirement also provides flexibility. It can help bridge the gap before retirement age and reduce the risk of penalties from early withdrawals. This chart from JP Morgan Asset Management compares $10,000 invested from January 2004 through December 2023. What it shows is that staying invested rather than trying to jump in and out of the market resulted in an average return of about 9.7%. The takeaway here isn't the exact number. It's that missing even a few strong market days, often right after downturns, can dramatically reduce long-term results. This is why confident investing focuses on time in the market, not timing the market. There are two questions that make investing safer. The first is, how diversified am I? The second is, how long does this money need to last? Short-term money prioritizes stability. Long-term money can pursue growth. This heat map shows the S&P 500 on any given day. Some sectors are up while others are down at the same time. This is diversification in action. Instead of relying on one company or one sector, your risk is spread across many. When markets move differently, they're not broken, they're functioning as expected. Investing works best when money can stay invested for at least 5 years. The volatility, which are the ups and downs, is normal. Volatility is not lost until you sell. Money needed in the next 1 to 3 years generally should not be invested. We experience a range of emotions when the market goes down and as it recovers. The biggest risk isn't the market, it's reacting emotionally, especially at the wrong time. This is also why risk management matters. Insurance, emergency savings, and cash flow planning all work together to reduce emotional pressure when markets move. I explain this connection more fully in my video called Insurance: What You Need and What You Don't. Now let's talk about what types of money can be invested and where it can go. Let's talk about two types of income, earned versus unearned income. Earned income includes wages, salaries, gig work, and certain military pay. This income can be invested in IRAs and employer-sponsored retirement plans. Unearned income, such as gifts, dividends, pensions, and benefits, cannot go into retirement accounts. However, it can be invested in a taxable brokerage account, along with any additional earned income. Traditional accounts may reduce taxes today and will be taxed in retirement. Roth accounts are taxed today and ensure no taxes in retirement. This is especially important for when you will be in a higher tax bracket in retirement. Employer plans may include matching, which is essentially free money. Opening a brokerage account involves 4 steps. Visit a brokerage website, open a brokerage account, deposit funds, and choose investments. Brokerage accounts offer flexibility. Your money isn't locked up, but taxes will apply when investments are sold. Let's talk about a taxable investing secret. Time doesn't just grow your money, it can lower your taxes. Although investing generally works best over 5 years or more, this chart focuses on taxes. Investments in a brokerage account that are held for more than 1 year are taxed at lower long-term capital gains rates. Short-term investments are taxed as ordinary income. You can think of long-term investing as a simple and perfectly legal way to reduce taxes over time. Market downturns will happen, and they often create opportunities to pivot thoughtfully. Market downturns are normal and temporary. They do not mean investing is broken. This visual, starting in March 2009 and spanning 10 years, shows over 400% growth, even after a major market decline. The goal isn't to predict downturns, it's to respond to them wisely. Understanding this long-term perspective is one of the most effective ways to reduce financial anxiety during uncertainty. Panic selling, stopping contributions, or moving to cash out of fear often causes long-term damage. This is not about timing the market, it's about staying consistent. Downturns can create opportunities. Dollar cost averaging by continuing steady contributions, buying investments on sale, and Roth conversions may cost less in taxes when values are lower. You don't need to predict the market, you need a plan for it. Changes in interest rates can create life planning opportunities, such as refinancing, reviewing debt, or reassessing goals. But opportunities only make sense when they align with your financial readiness. Changes in interest rates don't just affect investing, they also affect borrowing, debt repayment strategies, and cash flow decisions. If you're carrying debt and wondering how interest rate changes affect your choices, my video called Deal with Debt Your Way walks through practical ways to approach debt without one size fits all rules. Let's look at some actions and resources you can use to get started. Getting started doesn't require perfection. For brokerage accounts and IRAs, the steps are similar. Starting with a brokerage company's website. Choose the account, automate contributions, select diversified investments, and commit to staying invested. If your employer offers a retirement plan, you'll typically be automatically enrolled. You can adjust how much you contribute through your payroll system and choose investments by logging into your plan administrator's website. Investing confidence grows when your cash flow supports your plan. If figuring out how much you can realistically invest feels uncertain, my cash flow planning video walks through how income and expenses fit together in a practical, manageable way. Different goals need different tools. You can access these calculators by downloading the slides at tinyurl.com/talk-money-material. The slides are available in Google Drive under the Investing folder. These resources can help you find fiduciaries who are legally required to act in your best interest. The first is called XY Planning Network, and the second one is called Garrett Planning Network. They are both fee-only fiduciaries. Be sure to interview at least 3 professionals and research both the firm and the individual at investor.gov and BrokerCheck. Investing doesn't require prediction or perfection. As your earnings grow, So does your ability to adapt and take advantage of opportunities. Time in the market matters more than timing the market. Start where you are, invest consistently, give your money time to work, and keep learning, earning, and growing. You don't need to have it all figured out to begin. You just need to begin and keep going. Please subscribe to the At Talk Money Sense channel. To get a copy of the slides and additional resources, visit tinyurl.com/talk-money-material. If this video helped you think differently about investing, I recommend watching Preparing for Financial Uncertainty next. It helps you stay steady when things feel really uncertain. Thank you for watching.